Meow, everybody, I'm Cantonese Cat. Hey everyone, Cantonese Cat here. This is the 2-year yield monthly chart. I just want to start by saying that I'm a little bit of a rebel. I don't like to do what other people tell me to do because a lot of times when people tell you to do something, it doesn't necessarily mean that it's going to be in your best interest. It's just what other people want to tell you. I like to rebel. I like to be rebellious. I don't like to follow other people when they tell me what to do. Except I follow the trend. I do follow the trend. The funny thing is, a lot of people, when they tell you things, it's actually against the trend in the longer term. They're looking at more like a very, very short-sighted kind of trend as to what happened over the last, few months or so. They're not really looking at the greater trend in terms of what could happen, and they're just making assumptions based on recency bias. I don't like that. I'm here to provide you an alternative viewpoint to things against the traditional financial media. I'm kind of like the Alex Jones of finance of cats, if you will. And I just want to kind of push back against some of the narratives that are going out there right now. There are a lot of noise out there. Some people say that yields are about to drop. That's not good. That's going to lead to a recession. Some people say that yields are not going to drop because there's a lot of inflationary forces that are coming in terms of commodities, in terms of oil. Fed is going to have their hands tied. They're not going to be able to lower rates. And next thing you know, things are going to be a lot more expensive, but the company is going to have a harder time to sell their things because there's also a recession going on. There's stagflation. There's all that crap out there, right? Some people even argue that stagflation doesn't exist, which I actually kind of agree. But the key thing here is, the very key thing here is, a lot of people are talking a lot of things, and a lot of them may not even make any sense. So what makes sense? I like to look at data. I like to look at trend. I like to figure out what I'm seeing based on what the market is doing and figure out what the trend is doing and to go along with the trend. If there's a trend change, I like to know. I like to find indicators ahead of time to tell me what the trend change is, from what to what, and how long it could potentially be happening for. The Fed doesn't set rates. The Fed follows. The real market sets the rates. And rates are basically set by yields from bonds, depending on the demand and supply for bonds. This is a 2-year yield, and a lot of people look into 2-year and 10-year, and they look at yields to see what the real financial markets are doing. They are based on real market conditions, based on real supply and demand of bonds. The Fed just kind of follows most of the time. They can set some monetary policies here and there. They can send a clear message here and there, but most of the time they just kind of spend their time looking at what the market's doing. And when the market is doing something, they tend to want to do something together with it. They follow. That's thing number one. Thing number two, the Fed, they don't really do much other than that besides printing money. They see an opportunity to do quantitative easing, they'll take it. The reason why is because they don't want you to revolt. They don't want you to worry about your 401k. They want to increase money supply, to increase money velocity. They want to keep everybody happy. They want to keep the economy going. They don't want deflation. They want a little bit of inflation. And when they see an opportunity to bring on a little bit of inflation, they'll take it. Any kind of innovation that's going out there is going to bring on deflationary forces, and that just gives them more excuses for printing money. That's what they want to do. Of course, they don't want inflation to run too hot, but so far, I'm not sure inflation is running too hot. CPI for the last couple of months, yeah, sure, higher than expected. But they're also crappy government data. They are also lagging. And they're also seasonal. There's a lot of seasonality to that. The next CPI data is coming next week. I think it was April 10th. We'll see what happens. But so far, I'm looking at real market condition, I'm looking at rates, and there's really nothing telling me that it's going to end up potentially staying higher for longer. Because what happens is, if you end up staying at the same for a long time, it's probably going to bring on some volatility that's going to come on pretty soon. I'll show you why I say that. But the biggest question is this. A lot of people looking at the yields over the last few months, they're seeing the yields went from like 4.1% over to 4.7 for the 2-year over just the 3-month period. They get scared that they think yield's going to go higher for longer, and they think that it's going to keep on going up because there's a lot of inflationary forces that are not coming down. But what I'm seeing is this. I'm seeing an exhaustion of the trend. And what I mean by that is you really have to put up the RSI here. I'm seeing a big exhaustion when yield went up for about a year. The RSI actually went down. There's a lot of sign for exhaustion. This is called bearish divergence. It's pretty clear. Price go up, RSI goes down. Bearish divergence. This leads to a bearish move. And sure enough, we got a bearish move over here. Now, why did it keep on going up here a little bit? Unfortunately, you also have a little bit of a hidden bullish divergence over here that also needed some time to kind of work out when yield went up and the RSI did get reset down here a little bit, so it allows the room for RSI to kind of bump up a little bit more. But I think this hidden bullish divergence also kind of worked out a little bit because it did bounce up here, and now you're seeing a little bit of exhaustion right here. I'll show you why that is. When you see a big exhaustion top that's been going on for about a year, you see a lot of kind of these like bearish diversions going on for about a year. That really tells you a lot of times on the monthly chart that the trend's over and that you might be experiencing a pretty big trend change coming up pretty soon. For example, the last cycle top was shown with this increase over here for about 8 months or so. This was met with the RSI just basically going sideways, going flat. So this is also a bit of a relative bearish divergence. And sure enough, it went down afterwards, right? There's a lot of exhaustion that can be seen over here. And when things get exhausted, they roll over. Same thing over here. Yield went sideways, RSI went down. Relative bearish divergence. You're seeing the same thing over here. It's been exhausted for quite some time. It's been exhausted for about a year and a half, 2 years now. The other thing that I want to show you is when people talking about yields staying higher for longer, even though yields just been staying at a okay level, I guess, for a very long time already. And when things like that happens, you're going to end up having a potential trend change and potential very powerful move coming up soon. One way to illustrate that is through the Bollinger Band. If the Bollinger Band comes together, that basically tells you that price had been kind of staying at the same level for a very long time, getting ready for a bigger move. So one thing that I can show you here is like over here, things have kind of been going sideways here for a little bit. Bollinger Band squeeze, pick their direction, big move, right? Price when yields went sideways here for about 2 years. Consolidation, squeeze, went for a big move. We're about to have a very similar thing over here where I can see potentially a big move is coming with yields. Which way is it going to go, you wonder? Is the 20-month moving average just going to keep going, getting exhausted like that, and all of a sudden make a big turn up? Or is this actually looking like the 20-month moving average is rolling over and could potentially continue to roll over even further like it did over here on the last cycle? Like it did over here on the last cycle before that? What do you think? I think it looks like it's going to roll over. Price right now, not price, but yields right now, it actually looks a little bit exhausted. It did drop down here and it was able to break back above and kind of bounce and use it as a little bit as a support, but it does have that little exhaustion look to it, doesn't it? Even the support of the 20-month moving average is becoming less and less of a support, is turning flat. And when things turn flat, instead of pointing up, they're not going to be good support to push price up or push yields up a lot higher. The support is getting exhausted too, which is concerning for yields and maybe good for risk assets. Ichimoku Cloud comes with 2 lines. The Tenkan line, which is labeled in red, Kijun line, which is labeled in blue. Tenkan is a very, very important line when it comes to monthly charts, and I'll show you why that is. When a bull trend is about to develop, it needs to flip the monthly Tenkan from resistance over here as support over here. It flipped the Tenkan from resistance to support, and then it kept on bouncing it as support throughout this bull market for yields until it doesn't anymore, until the Tenkan really starts to get exhausted. Bounce over it about 3 times, found support, you have a very, very weak bounce, broke down below the monthly Tenkan, back testing it, failed once, twice, 3 times, potentially 4th time here. We'll see what happens. But when you have a breakdown of a key support, and when you have a back test like that, if you fail to break back above, and if the line is starting to kind of roll over, when the line's starting to kind of roll over, the last cycle, when you broke down below that, you tried to back test and failed to break back above, this is extremely weak. I'm not sure if it's going to stay higher for longer, to be honest. I am a little bit worried about yields just going down. Actually, I'm not worried because I'm holding a lot of rate sensitive assets that could potentially do great when there's good global liquidity being squashed around, and when there is a lot of yields going down, allowing it to be easier to gain access to capital. One of which is going to be small cap stocks. This is the IWM ETF, which is an ETF that represents Russell 2000 small caps. It's very cyclical. It's very rate sensitive. When rates are high and when the financial conditions are not good, it goes down. When rates are low or when the financial conditions are good and when there's increased global liquidity, it tends to go up. Right now, I think we're at the point of the cycle where things are probably going to go up for another 2 or 3 years. And I'll show you why that is. We were just talking about the Ichimoku cloud. You remember when I was talking about the red here being the Tenkan, the blue here being Kijin. Whenever things need to be getting a bull market, it needs to flip the Tenkan from resistance to support. And it needs to get over the Tenkan for it to be more bullish. Another thing that tells you whether or not it's going to be bullish is whether or not the Tenkan is crossing over the Kijin. When the Tenkan here, which is the leading line, crosses over the Kijin over here, which is the lagging line, when the leading line crosses over the lagging line, you have a bullish cross. And this bullish cross can basically precipitate a very, very powerful move that could be very, very bullish, that can last anywhere from 1 to 3 years. This is the last bullish cross over here. Price went up for about a year. The bullish cross before that, well, it was disrupted by COVID, but eventually it reversed pretty quick. Bullish cross before that right here, followed by a big giant green candle, went up for about 2 years. Bullish cross before that, and over here, 2012 or so. Bullish cross, big giant green candle, went up for 3 years. Bullish cross, went up for about a year and a half. Bullish cross. The Tenkan and Kijin actually is fused right now, so this is a pretty nice look for IWM. There is a potential because the larger caps have been running for about a year, year and a half now. There's a potential for rotation to come into the smaller cap stocks. It's probably time, and because of how cyclical it is, because a lot of things are, including Bitcoin, including Ethereum, including altcoins, including big cap stocks, are telling you that global liquidity is going up. Most likely the money is going to flow into the small caps too, and that's what it's doing. That's what I'm seeing. Another thing of the Ichimoku cloud that you can see is whenever price bounces from the top of the cloud, it tends to get pretty bullish for about 1 to 3 years. You can see here, bounce from the top of the cloud right here just a couple months ago. The time before that, bounce from the top of the cloud, went up for about a year. Time before that, bounce from the top of the cloud over here, ran up for about 2 or 3 years. Bounce from the top of the cloud over here, went for about 3 years. So I think we just had this kind of bounce happen. It can potentially go on for another 12, 24 months, maybe potentially even longer. And now you have people having a lot of disbelief. A lot of people are basically worried about the market still. When things are actually looking pretty bullish, when things are actually looking like they have a pretty significant bull trend that's being built up. Bollinger Bands. What's the Bollinger Band expansion and what does the 20-month moving average tell you? Let's look at what it did before. Over here, you have a little bit of Bollinger Band squeeze over here, 20-month moving average flat and then point up, strong acceleration right here you can see. Went up for about 3 years. Flatten, slightly downtrend, Bollinger Band squeeze, Bollinger Band expansion, price went up. 20-month moving average pointing up. Bollinger Band squeeze, went down a little bit, accelerated back up, went up for another year or so. I think we might be at the beginning of a very powerful bull trend that can keep going for another 12 to 24 months, potentially longer. Because you're seeing the 20-month moving average is really starting to accelerate up pretty fast, and you're starting to have a squeeze over here, followed by a Bollinger Band expansion. Again, over here, 1 year or so, over here, 2 years or so, over here, 2 years or so, or 3 years or so. It looks like it's got some pretty nice thing going here. Now, I did spend a while talking about IWM on another video just last week. Feel free to check that out. But I just think I'm still seeing a lot of things that doesn't really make sense in terms of what traditional financial media is talking about. I just want to share with you these things. I want to reiterate a lot of these things. These small cap stocks, a lot of times they have a lot of depth, so they're really rate sensitive. If people are really worried about rates, then how come you actually end up having a lot of increase in terms of this bull trend here? It looks like it's just about to start running. If people worry about rates, how come that is the case? If people worry about rates, how come you have these big giant green candles over here with huge buying volume? If people worry about rates, how come you have a bull flag over here and you end up breaking above the bull flag and with a bullish expansion with most likely bullish continuation? If you're talking about people worry about rates, then how come big money just went crazy in terms of having inflow coming in like it did over here and potentially going to push the price up a lot higher? None of this make any sense. The trend is up. That's what I'm seeing. Another thing also doesn't really make a lot of sense to me too is if you look at some of the other things too, one of my favorite stock to follow and that do have a position in is Affirm. If people worry about rates, then how come you have these big giant buying over here for the whole year, and when price went down as a correction move, as a bull flag, you have significantly plummet in volume? Like, they're not selling. If the big money are afraid that there's going to be higher for longer, they worry about rates being potentially even higher or staying higher for longer, it's going to hurt the economy. Like, people wouldn't buy a stock like Affirm. Affirm is a money-losing company. Their financials are getting better and better. Their growth is getting better and better, but they're a money-losing company. They're very, very rate-sensitive. You're talking about rate-sensitive company, Affirm is the face of it. If there's risk on, Affirm's going to go sky high. If there's risk off, Affirm's going to plummet. It plummeted, but over the last year or so, this is one of the stocks that woke up from the dead. And right now, the big buying volume is counteracted by very, very pathetic selling volume. So as far as I'm concerned, to me, anything that's getting lower than here because of such pathetic volume that the bears is showing a lot of weakness, I think it's just a matter of time when price is going to go up from here, because all it takes is just a little bit of buying pressure for the price to go up. This is very, very pathetic in terms of the selling volume. Like, this is what you look for when you chart. You're trying to figure out what big money is doing. You look at this. It doesn't make sense if people worry about rates going higher. Rates have just been hitting resistance after resistance after resistance, and people are getting bullish on rates. Affirm has just been going down, down, down on decreasing volume, and people think it's going to go a lot lower. It doesn't make sense. If rates are going to be higher for longer, then how come you have one of the best bullish setup in here in Robinhood? Like, Robinhood is literally one of those things that are going to be the most economic sensitive. You think about retail investors coming in. You think about these, younger folks trying to get into investing. You're talking about Robinhood. This is one of the most rate sensitive stocks. Guess what it's doing is it's developing a bull trend. The Bollinger Band expansion is happening. Right now, so far, 3 days in a trading day, you have a little bit of redness over here. You couldn't even get back down below the upper Bollinger Band. This is how bullish it is. The trend is very bullish. Buy volume, sell volume is low. Buy volume is big. Sell volume is low. Buy volume is big. Not a whole lot of people want to sell this stock anymore because you already have this like a 2-year base over here. If rates are staying higher for longer, then how come Robinhood is having such a big bullish trend? It's probably going to keep going up for higher for longer. It doesn't make a whole lot of sense, does it? If you look at A stock like SQ, this is also going to be very, very rate sensitive stock, isn't it? Square, Cash App, Fintech. Then how come you have a Bollinger Band expansion over here and 20-month moving average is curling up? How come big money is coming in with big inflow coming in with buy signal right here just 2 months ago? That doesn't make a whole lot of sense, does it? So Fintech is telling a different story compared to what the traditional financial media is telling you. IWM is telling a very different story compared to what traditional media is telling you. Rates are telling you a very different story compared to what traditional media is telling you. What about these like high-risk stocks, like the ARK fund stocks, like Zoom, Roku, all that stuff? Price has been forming a bull trend here too. It's basically been forming a pretty big giant bull flag. The Bollinger Band is expanding. 20-month moving average is pointing up. Price has been about half a year above on the upper part of the Bollinger Band. This is starting to develop a bull trend here. This is basically what looks like at the beginning of a bull trend. Over here, you have Bollinger Band squeeze over here on the monthly, Bollinger squeeze over here on the monthly. When it starts expanding, is when things start to get a lot more bullish. I think we might be at the beginning of a bull market here for ARK. That doesn't make a whole lot of sense, does it? If stagflation is going to come, you think ARK is going to develop the beginning of a bull trend over here? It doesn't make a whole lot of sense to me. Does it make a whole lot of sense to you when you have stagflation coming and Dogecoin is doing well? Does it make a whole lot of sense for you to look at Dogecoin and see that you have a Bollinger Band squeeze over here, just like it did on the last cycle, and you have huge Bollinger Band expansion over here, up and down, allowing price to go up even a lot higher? It's such a bullish bull trend that it got way above the upper Bollinger Band and price had to kind of correct. Even when it corrected so far, it's just touching the upper Bollinger Band. It couldn't even get inside a Bollinger Band over here. And you have a 20-month moving average that's just pointing up like crazy, just like it did at the beginning of last cycle. I am seeing some pretty bullish things going on even for Dogecoin. I can show you a bunch of altcoins too. I mean, like they're as risk on as it gets, and they're looking super bullish. Doesn't make a whole lot of sense when stagflation is going to come, that you're starting to have all these big money getting into all these risk assets when rates are hitting resistance. Again, none of these things make any sense. Look at Bitcoin. Like, this is how bullish Bitcoin is causing, again, very, very nice beginning of a nice bull trend over here, which looks kind of like this over here, with Bollinger squeeze and expansion, with 20-month moving average starting pointing up, just like previous cycles. It looks exactly like that. It just got so bullish it went way outside upper Bollinger Band and had to kind of came back down and touch upper Bollinger Band over here a little bit just to cool down, just to went sideways a little bit just to cool down. And people are talking about higher for longer. People are talking about recession. People are talking about yields staying higher for longer. I don't. Anyway, one last thing I want to show you is the DXY. DXY is the US dollar. The US dollar is not that strong right now. A lot of people are saying that the US dollar has been very strong because they have this recency bias. They think that price has been, going up over the last few months. It's probably going to keep going up. I'm not sure about that because this is the Bollinger Band with a 20-month moving average being shown here. Whenever you have the 20-month moving average start to turn over like that and roll over, you generally have a pretty good odds that you're going to have a pretty downtrend here for the US dollar. Happened here, is happening now. This is a perfect rejection off of the 20-month moving average. And the 20-month moving average is going to serve as resistance from now on because it's pointing down. And right now it's got a little bit, the month before that, it's got a little bit of like hammer top, which is a bearish candle if this is a top. There's such a thing as the hangman candle, and that's exactly what this one is. Over here, you're having another candle top, an inverted candle top over here. These are pretty bearish looking thing. Like the 20 moving average is pointing down, it's going to slap the dollar down further. That's what it looks like. And guess what? When US dollar goes down, guess what's going to happen? Risk assets goes up. Everything lines up, doesn't it? Everything lines up, doesn't it? Anyway, been 25 minutes. Just want to share with you my thoughts about the market. There you are. Thank you for listening. Have a good one. Bye.